Let us start with the IAS 36 impairment, right? And so firstly, let us look at what is mean by impairment. Okay, sudden fall in the value of asset. Is impairment. Is impairment. For example, we was carrying an asset to somewhere which had a fair value of $1,000, but we dropped it and it got damaged. Now its value is 700. So the amount dropped by 300. That's impairment. Okay. Now, what is mean by impairment loss? Uh, the amount by which carrying amount of an asset exceeds its recoverable amount, as I just told. Uh, Previously, it was 1,000 to 700. Previously, as I told you, just I gave you the example. We were carrying the asset and it got damaged. Now it has the value now. Previously it had a carrying amount of 1,000. Now it has the recoverable amount. Now it has a recoverable amount of 700. So what is the impairment loss? 300. That's it. And now fair value. What does we mean by simply fair value means the market price. So the standard gives this definition with saying the price which would be received to sell an asset or to transfer a liability in an orderly transaction between market participants at measurement date. Okay. Now, what is recoverable amount? The higher of fair value less cost to sell and value in use is the recoverable amount. The higher of fair value less cost to sell is recoverable amount. Now, what is value in use? Very simple. The present value of the future cash flows cash flows expected to be derived to be derived from an asset or cash generating unit. Right now, what is cash generating unit? The smallest identifiable group of assets assets which generate cash flows. That are largely independent of the cash inflows from other assets or group of assets. So we have various type of indicators of assets. Indicators of impairment. We have two types of indicators of impairment, right? And what are those? Let me explain to you folks. Uh, we have one are the external indicators, other are the internal indicators. What are the external indicators? Increase in interest rates, increases in industry tax rate, recession, sudden fall in the value of asset, technological change, change in fashion, adverse change in legal environment, okay, now internal indicators. What are the internal indicators? Physical damage to the asset, change in use of asset, uh, cash flow. Well, that is the adverse change in use of asset, and then cash flow for maintaining the asset is more than the budgeted. Now, how to measure the recoverable amount? How to measure the recoverable amount? Here it is. Recoverable amount. Fair value less cost to sale value in use. Recoverable amount is the higher of fair value less cost to sale or value in use. Recoverable amount is determined for an individual asset unless the asset does not generate cash inflows from continuing use, which are largely independent of those from the assets or group of assets. If this is the case, recoverable amount is determined for the cash generating unit for which the asset belongs. Okay. And re- remember, now let me give you an example how it works. For example, one asset has a fair value less cost of sale of 1050. Carrying amount is, let's say carrying amount is 1000. Okay. Let me change this. It's not 1050, it's let's say 950. Fair value less cost of sale is 950. Less cost of sale is 950. And value in use is 800. So less fair value less cost to sale 950. And our impairment will be, that's our impairment 50. Move ahead. Let's say fair value less cost to sale is 900. Value in use is 980. Now in this case, what will be the impairment, folks? It's simply less value in use. $90, and we will get 20 impairment. Now remember one thing. That according to IAS 36, what is value? As we already looked at, value in use is the future expected cash flows, and IAS 36 says that while calculating the or while determining the expected future cash flows, we have to do it on the present value basis. Number one. Number two, maximum 5 years expected cash flows can be considered while doing the impairment calculation, not more than that. That's what IAS 36 stated. Okay. So far, so good. I hope you get it till here. Now, let us look at the example. All right, now we have an example in front of us which saying ABC holds a patent on medicine drug. The patent expire in 5 years. During this period, the demand for the drug is forecast to grow 5% per annum. Experience shows that competitors flood the market with generic version of profitable drug as soon as it no longer protected by patent to generate significant cash flows after 5 years. Net revenue from the sale of drug worth 100 million last year. The organization decided that 15.5% is appropriate discount rate for the appraisal of cash flows required. What is the requirement? Compute the cash flows. Now let us do that. Firstly, year one heading year, next heading cash flow, then next heading discount factor, which is at 15.5%, yes, and finally present value. So year one, cash flow, 100 million into 1.05, and we will get 105. Discount factor of 15.5% is 0.865. It will be given to you in exams. 91% in year two, again, 100. The rate 100 into 1.052, and we will get 110.3. This rates, the interest rates and discount factor rates will be given to you in the exam, right? While for the cash flow purposes, I'm just using the ready-made, values. Otherwise, you can do it by 1 divided by 1 plus 0.151555 into number of years. Okay, so it's 110.3 and then 0.749, you will get 83. Then number three, for third year, 100 into 1.053, you will get 115.8. Oh, sorry, 115.8. It's 0.649, 75, 100 into 1.054, it's 121.6. No, 121.6. It's 0.561, 68, and lastly, year 5, 100 into 1.055, and we'll get 127.6, 0.486, and I'll get 62. I'll get what we will get. Total value in use is 379. That's how it works. Well, we get it. And now let's move ahead with this standard. Cash generating unit. What is cash generating unit? We already discussed the definition, but let me explain it to you more. One asset has more than one component. And every component of organization helps organization to generate the revenue This is known as cash generating unit. Okay. Let me give you an example for it. For example, airport. You know, for example, this is an airport. You know, it's an airport building. It's runway. It's where the planes are landed. Sorry for my drawing. Not too cool. That's the planes. Okay. It's airport. It is airport launch and all. You know, every component without can you think that without any of the component these flights and all can operate without the runways or the airport building or the plane. So these are the small number of components like plane, like building and all, airport building, the runways and of any other component of it. Without it they can't operate, right? So this is known as cash generating unit. uh, then another example, the London bus service. You know, they have the various type of the routes, the blue route, the red route, the green route, and so on. Now you can take the bus from either of the side, the blue side or the red side and the green side, and you can travel either here or here in just one ticket, right? So this is also an example of cash generating unit like that. Such services can be found in United Arab Emirates, Dubai, or in Moscow. The trans systems is just like that. You will be visiting with the one ticket all over the day, anywhere you want. So that's cash generating for you, folks. Uh, now, so what is the treatment, accounting, allocation of impairment, the cash within cash generating unit? So the impairment treatment of it. Number one, firstly, write off goodwill, allocate it to cash generating unit. Two, write off, write off asset completely destroyed. Then the remaining impairment should be allocated between other assets on pro rata basis, right? Based on the carrying value of asset in the unit. While allocating the impairment loss, the carrying value of the asset should not be reduced below the higher of fair value less cost of sale or value in use. In this scenario, remaining loss should be allocated remaining to the asset of the unit on pro rata basis. And remember, do not locate the impairment to current assets. Do not. Okay. All right, now here it is the example at January 2009 ABC company. ABC company got, wait a second. On January 2009, ABC company paid 2,800 for a company whose main activity consists of refuse collection. The acquired company owns four refuse collection vehicles and government license without which it could not operate. At January, the fair value less cost to sell of each lorry is $500. The company has no insurance cover. At first step, one lorry crashed because of its reduced capacity. The organization estimates the value in use of business at 2,220. So how we will do it? Let us compute the impairment loss. 1st January, impairment loss. 1st Feb, goodwill. Firstly, 300 on 1st Jan. Then intangible business asset, that was 500. And then we have, what was the intangible business asset? The lorry, the license. Okay. And then lorries. 4 lorries, 500 each, 2,000. Right? Impairment loss. One lorry was completely crashed. So its carrying amount at 1st Feb will be 1,500. Okay. Now look at, it has a total value of 2,800, as you can see over here, right? 2,800. Now after that, it has a value of 2,220. So 2,800 minus 2,220, 580. 500 was reduced from lorries. 80 will be reduced from 80 because we have no more impairment. If it would have been, then goodwill will be reduced to 0. But at this moment, we have 80 left, so we'll be deducting it from goodwill only, and the carrying value of the goodwill at 1st Feb will be 220. License value will be exactly 500. I hope you get it till here. Now, now let us discuss about the reversal of impairment. Well, in case of goodwill, impairment can never be impaired. In case of assets, in case of assets, if indicators of impairment no longer exist, impairment can be reversed. Last, in case of revaluation model, impairment can be reversed up to the maximum to carrying value. Which asset had the time of at the time of first time impairment? Right? What does it mean? Let me show you. For example, we had the asset who's carrying who had a value of 2000. Suppose it got depreciated and now it has a value of 1800. But here it got impaired, and after impairment, its value is 1500 after impairment. Then now again it's got impaired, but suddenly there is no remaining indicators of impairment all. It's got appreciated. But now impairment is reversed completely, and now its value is 1900. So standard says that the impairment cannot be reversed to the carrying amount which it had before the first time impairment. That means it cannot be reversed for more than 1800 in this case. I hope you get it, and it brings us to the end of the standard IAS 36. I will see you soon with the next session very soon. Till then, take care and tada bye bye.